Are you looking for a program to help you build more prosperity in your life? Well, you've come to the right show. Tonight, we're going to be talking about an often misunderstood and misused part of the financial process. We're going to talk about how to build a better financial plan. So stay tuned for this edition of The Master of Money. Hello, everyone, and welcome back to the Master of Money program. I'm Steve Beeman, your host, and whether you're joining us live here in our audience for the meetup meeting or you're joining us through the streamed videos around the world, we're glad you're with us. And I want to personally thank you for taking the time as we work to build a better and more prosperous tomorrow for everyone. Now, tonight's program, we're going to dial back the complexity a bit from last week, and we're going to talk about one of the real foundational things of building a wealthy life. That's building the right plan. Now, it's funny because what oftentimes seems so simple to people is frequently not built or built wrongly. So we want to talk about tonight the reasons people don't build and execute on a plan, and then we'll follow on next week with more details on how to build comprehensive financial plans for you. So stay tuned. This is a real part of building that fundamental part of the building blocks of your path to prosperity. Now, last week, we had a wonderful show with Tim Newell of Harvest Investment Services, and I was pleased with all of the email I got about it. There were a lot of good questions and a lot of great comments. Tim and I talked about 3 takeaways from last week, as you may recall. Number 1, we talked about this definition of risk and how Wall Street often confuses this issue by using words like standard deviation or correlation to describe risks they have. Well, that doesn't always connect with Main Street when you and I have one notion of risk, and that's called losing money. But that tied into the second point, which is a myth often promoted to you through the mutual fund industry, who will look at you and say, gee, look how good your returns would have been had you just been in for the 3 best trading days. In other words, once you're in, stay in forever. Set it and forget it. Buy and hold. What they don't tell you is those 3 best trading days were premiered the day before with the 3 worst trading days. So you have the 3 worst days followed by the 3 best days. So a better question might be to them, what would my returns be if I had gotten out before those 3 really bad days? And then finally, Tim and I talked about the risk that millions of Americans are taking in their 401k plans when they're invested in either a target date fund or a stable value fund, assuming that history will just repeat. We talked about this long-term bull market we've been in bonds and how for 20 years we've seen declining interest rates. Now, there's nothing that can guarantee tomorrow rates are going to rise, but common sense tells you they certainly can't go below 0. So if you're in one of those funds or find yourself questioning some of those issues of risk, we welcome you to write us at questions@safefinancial.org, and we'll get an answer to you right away. Now, as you know, each week I take a member question that came to me and I expand on it for purposes of our discussion. Last week I was written and a guy said, Steve, I love the program. I learn a great deal. It's great content, but I'm not clear totally on why you integrate geopolitical economic events into financial events. Seems to me I'm just an investor in American companies. Well, I appreciated the question, and the way I responded to him, and I'll tell you now, is this. We live in a highly globalized world. Over the last 20 years, this economy of the world has shrunk. So we now do business across the board equally with what used to be across state lines. If you own stock in General Motors, General Electric, Microsoft, Apple, or any of these big American companies, you own an interest in the globe. If you're invested in places like Honda Motor Company in Japan, you've got an investment that transcends the world. All we are seeing now is an increasing speed at which the world is coming together, truly at the speed of light. So the geopolitical events happening in Europe and China, South America, directly affect the earnings of those companies here in America. And that's why we talk about it. As you build your plans and build your wealth, you want to know what's going on so you don't get caught in a trap because you were unaware of something going on in Greece or in China or anywhere else. So we try to give you a little overview of that each week to raise questions more than anything and make you aware of what's happening. So I want to thank that gentleman for the question, and we appreciated his comments and the question itself. So write us always at questions@safefinancial.org. I do appreciate the question also because it gives me a beautiful segue into the geopolitical world, where clearly the #1 event last week was the ceasefire agreement in the Ukraine. We've talked about the Ukraine at length, and we've talked about how Russia and Europe are really in a problem here that could escalate to a hot war if people aren't careful. Europe gets a great deal of natural gas from Russia, and that is a key kind of a linchpin the Russians have for negotiating this. But last week they came to a ceasefire. Both the rebels and the nationalists are unhappy with it, so we're not sure it will hold. But for the time being, we have a ceasefire there, and that you saw directly affect the stock market last week, with it rising to new record levels. Secondly, I want to touch on something that's a global geopolitical event, but it ties right back to the United States. The New York Times wrote an article about the forthcoming net neutrality talks from the FCC in America. Well, interestingly, that ties to another article I read about how China's own net neutrality laws are being passed. What China is doing is considering, much like the U.S., limitations on privacy within the internet, private technological development. They see it more as a public utility, which is what the United States wants to do. Well, I thought these were interesting because I don't want to make a political comment, but I do want to make an economic comment. As you see these more regulated, that leads to a declining amount of technological innovation. The last thing you and I want is not to have more bandwidth, not to have faster internet, not to have these things that competition brings about. So we hope that the net neutrality laws, as good as they sound, won't be implemented in the U.S. and will be taken out of place in China. We need the internet globally to be thriving and competitive and building speed and capacity constantly. So we're optimistic that that'll happen, but I wanted to make you aware of it because if you own the tech sector especially, if the net neutrality laws pass in the U.S., you're going to see some of the big internet providers hurt bad. So that was in our geopolitical world, which kind of ties into the U.S. economic side too. In January, much to everyone's surprise, we saw a big slowdown in retail sales. In fact, the biggest slowdown since about 2008, I think it is. That's not good. We came off of a strong second quarter, a good third quarter. We hoped for a good fourth quarter, and it seemed like that was happening up until the end of December. January has been a total turnaround. We saw, again, what is continuing to lead you and I to see a weak economic recovery. Yes, the U.S. economy is doing okay. Yes, confidence seems to be okay in the economy. However, we keep getting indications like this retail sales number that make us wonder whether or not the recovery is going to stay in place. Keep an eye on it with us here on the Master of Money, because as this first quarter develops, we have a lot riding on it. Remember, the Federal Reserve is looking at interest rates, and if these numbers slow down, it will certainly put a hesitancy on the Fed to raise those rates. Gallup's confidence index, and we talked about Carl Gallup's comments about how the government plays the unemployment numbers, but the Gallup index they have, and this is an interesting dichotomy again. Retail sales slowed, but the Gallup Confidence Index is at its all-time high. It was positive again for January, so you have 3 straight months of a positive confidence index. It leads to this, again, this schizophrenic feeling. Yes, we're recovering, but no, I don't really feel like it. Well, the fact of the matter is the U.S. economy is growing at a 2% give or take rate. That's not great. We'd like to see it at 4, 4.5. But it's better than 0. And when you have China slowing down and Europe in turmoil, I'm glad to keep what we can right now. Now, once again, if you look at the cause of the slowdown, we have a couple of things. You've got weather-related issues in the Northeast, where the Northeast got hit with another massive snowstorm. Oh boy, I'm glad I don't live there. Chicago's had 1 storm this year, and I hope it stays there. But the second thing is this strike going on in the heart, and I should say the shipping lines out in California. The Port of Los Angeles is effectively shut down because of a union labor problem. This is causing our exports and our imports out of Los Angeles to stop. Now, there's been a lot of talk about the hit that will bring to agriculture because we can't get products out. Best research shows that this particular labor issue will not cause an enormous economic issue, but when you take it together with the weather, believe it or not, that's enough at the margin to slow an economy down, and that's exactly what we're seeing. So as you go forward, and this week we'll be watching the Port of Los Angeles and its labor negotiations, we'll be watching the weather, and we're looking for those retail sales, seeing if they come back up or if they stay down. Highly important for you as you build your plans for 2015. Now, major indexes last week jumped up once again to record territories. They did it because of the settlement in the Ukraine and the optimism that brought about, but also a resurgence to some extent in the energy sector. We've talked about how energy is such a huge part of the U.S. economy, and last week the energy sector rebounded on some strength in the oil business or the oil prices. Now, we believe those oil prices are going to stay pretty low, and so we think the energy sector long-term is in kind of a bearish position. But short-term, they certainly came out good last week, and that caused the markets to run into record territory. We had the S&P up 2.5%, following on a 3.5% gain the week before. The Dow was up a very healthy 1.6%, following again on 3.8% growth the week before that. And the NASDAQ didn't keep up. It was more flat, following on its 2% growth the week before. So the markets rebounded nicely. We came out of a poor January. Looks like February is a little stronger. Again, we're monitoring the valuations of the market constantly. In our second segment, we'll be getting the take from Superstock Investor on what they think is happening in the trading world. So stay tuned for that. Now, the VIX that we often talk about has gotten slammed lately. It's down another 24% following that 15% drop the week before. That's indicative that the institutional world doesn't see the volatility in the near term. Now, long term, we've talked with Superstock, we've talked with others, and we believe volatility is going to be in the cards for 2015. But in the near term, that is the next 4 weeks or so, the markets seem to be somewhat steady, and that's causing the VIX to drop in prices. But we keep an eye on that, and I look forward to hearing Jeff Garbaz's comments later in the program. Now, as I said tonight, we're going to go back to basics. We're going to talk about this idea of financial planning. And I'm telling you, whether you're 18 years old and just starting out, you're 30 years old for the first time thinking about money, you're 50 starting to really focus on retirement, or you're 70 and you're in retirement, the idea of building and maintaining a very sound, comprehensive financial plan is in your interest. And I want to talk when we come back tonight about not just what that plan is at the core, but I want to talk about why people don't do it. Because we find talking with retail investors daily that millions of you don't do these things. I want to talk about why not. So the program will continue with the discussion of financial planning. Why don't we always do what we should do? So stay tuned as we come back for the rest of tonight's Master of Money program.
It's only a car. A car is a car is a car. With nuts and bolts and leather and cogs and steel and wood and glass. Intelligent wipers and head-up displays. Alloy and oil. Sensors and sound. Digital mapping and satellite tracking, twists and turns and smiles and miles, infrared eyes and self-drying brakes, and one little key. A car. It's only a car.
Welcome back to the program. As we've often said, our mission on the Master of Money is to help build a better path to prosperity for millions of Americans. We're out to build a wealthier community, one person at a time. So we hope, I should say, this program helps you along your path. Now, often, a core of the process for building a better path is to have a plan in place, a strong, sound, comprehensive financial plan. And the sad thing is, I've talked to thousands of people who don't have these. The question is, why is something so obvious and so simple oftentimes not done? Well, we're going to look at that tonight and hopefully come up with some answers and then build from that on how we go about doing it. Now, the fundamentals of building a financial plan are frankly very simple. I want to give you an easy example from which we can then build. Let's assume for a minute that you're 35 years old. You earn $50,000 and you're happy with that income level. So you're beginning to think to yourself, okay, if I could live like this in perpetuity in retirement, I'd be a happy person. All right, the simplest and most basic way then to go about starting a plan is to take that $50,000 divided by what is your expected rate of return. Now, in reality, I talk to people all the time who expect to earn way more than they really can in the markets, but let's use a return of, say, 6% and say that's the expected return for our individual 35-year-old. Well, in order to sustain a $50,000 income at 6%, that person would need to have assets of about $840,000 put away to generate that income. Now, that sounds pretty difficult, but let's make it a little more difficult. Let's add taxes. In a normal world, we have to plus up what we save by taxes because you're going to lose that on the growth. So in reality, our 35-year-old has to earn more like $1 million or $1,020,000 to generate a 6% return of $50,000. Now, you're shaking your head saying, wow. Well, the way to then further break that down is to say, okay, I'm a retail investor. I'm 35 years old. I want to live on $50,000 a year. I have roughly 35 years of my productive life left. And yes, I've extended it to 70. I think one of the key misunderstandings people have is that we're going to always continue to retire at 65. Our life expectancies are rising past 90 and 95 regularly. In fact, I just read where scientists think the first person who will live to 125 years old has already been born. Point being, we're going to live a lot longer. So if you're below, let's say, 50 years old, you ought to plan on working a productive life to at least 70. So if you do that, this person has 35 years of productive life left to sock away what is about $1.2 million. So if you divide it up, that person would have to earn over and above their retirement expected income of 50, an additional $34,000 a year. So our $50,000 person looks at the world and says, I need to put an additional $34,000 in my income or I can't retire. Now that's pretty disheartening and pretty depressing. But let me give you just some easy information to show you why it's not and why there is in fact real hope. Let's first of all start with the easiest thing. In a well-done financial plan, you're going to avoid the taxes of the money growing on the way up. Whether it's through, and these are simple things, IRAs, 401ks, KIOs, SEP IRAs, whatever that plan might be. That takes off that top part of it right off the mark. So now our retiree hopeful is down to an $840,000 nut. Furthermore, it is a reality that when our 35-year-old retires, and let's say at 70, he's going to get Social Security. Now, I know there's a lot of talk about whether Social Security will be here or not, but let's talk truth. There's about $2.5 trillion in the Social Security Trust Fund. In addition to that, they're bringing in about $800 billion a year in taxes. Now, the outflow in Social Security is about $800 billion as well. So we're not touching the trust fund yet. Now, it slipped a little bit a couple years ago, but as the economy grows, it gets back to equal. The reality is, with some minor tweaks to Social Security, one of which is raising the retirement age, we'll be able to sustain that program for a very long time. So if that's the case, this person then can look out to 70 and say, I'll probably get $2,000 a month or about $24,000 a year from Social Security. Well, what that's done now is bring that person's required capital income in half to about $2,000 a month itself. That's more like $400,000 that the person has to put away over the course of their 35-year productive life. We're getting much more reasonable. Now, in addition to that, I'm assuming that they only return enough in that capital that they save to cover the cost of inflation. Right now, running at, let's say, 2%. Well, the reality is, by knowing what you do with your money, you can grow it much, much faster than inflation. So that cuts down on it. My point is, there's an optimistic way, very simply, to start looking at a plan that can put you in the position of retirement. So the question is, why don't people do it? And this is a question that boggles the mind of billions of us in the business, or I shouldn't say millions, but thousands of us in the business. Why don't people do this? Why don't they start out at 18 years old with a sound plan, updated at 30, 40, 50, and then at 65, 70, live well off of it the rest of their lives? Well, there are a number of core reasons, and I want to share those with you. First of all, it is common individual psychology to either believe or perceive that it's too late to start. I talk to people all the time who are 50 years old. They've got nothing put away. And when I ask them why they don't have a plan, they say, well, it's too late. I'm going to retire in 15 years. I don't have anything. I've kind of accepted it. I'll live on Social Security. Well, that's not necessary. It's never too late to plan. If you're 80 years old and you think you might live till 90, you should have a plan in place. If you're 60 on your way to short-term retirement, you should have a plan in place. There are a lot of issues that you face when you retire on how to get Social Security, how to fund your medical care, how to spend and live with the money you've got. A sound plan gets you there. So this notion that, well, it's just too late, I don't buy it, and I would ask you to rethink it if you're in that camp. That ties to the second issue, which is so common, especially in the young people. And that's the opposite side of the coin. And they're thinking that, no, there's always tomorrow. Oh, yes, there's tomorrow, but we should plan today. I think it was Benjamin Franklin who said in one of his very wise statements, we should pray like we're going to live forever, or pray like we're going to die tomorrow, but save as if we'll live forever. It's a very wise statement. And the younger you are, the more capable you are of building a plan that will accommodate your needs. So if you're 18 years old and you happen to be watching The Master of Money tonight, take heed. Start to look at a plan. If you do it right, the power of compounding, which is my third bullet point, is exactly what will get you where you want to go. We've talked about that magic bullet of finance before, the power of compounding. Well, the fact of the matter is you have to understand that in order to desire to put away the capital you need. Remember that if you're a borrower, compounding plays against you. But if you're a saver and an owner of capital, it plays very much in your favor. If you can build a plan, and the earlier you start, the better, but it is never too late. Utilize the power of compounding to build your financial wealth. And then finally, and this may sound trite, but we really welcome you to become a master of money. It's sad when someone looks at a plan and says, I want to retire here, I'm currently here, I don't see how I can get there, because they don't understand the tools at their disposal. Whether we're looking at tax deferral items of insurance, annuities, KIOs, IRAs, whatever that might be, if we're looking at ETFs, mutual funds, whatever the investment might be. The fact of the matter is, by becoming a master of money, you will know where to go. We've had on this program experts from day trading. We've talked about real estate. We've talked about insurance. We continue to talk about topics that are relevant to you. Now, if you'd like to see the archives of those programs, please visit safefinancial.net on the web and go through and take a look. We've got, I think, 24 Master of Money archives up there for you, together with Safe Insights, interviews we've done, all things geared toward getting you a better path to prosperity. Take advantage of it, because it's one of the things that we think is so critical. So there are 3 takeaways I want you to have tonight. And again, we're going to follow up on this next week with more detail on how to build a plan. But tonight, I want you to think of 3 things. Number 1, don't be apathetic. The biggest crime in today's society is that people have a high level of apathy when it comes to, believe it or not, their money. You know, if you talk to people and you say, what are the most important things in your life? They'll tell you their health, their wealth, and their family. Those things, right? The reality is we do nothing for our health. How many people really do go exercise? And we do very little for our money. How many people have a good plan in place that they follow? Well, this apathy that's rampant in America because of our wealth is only destroying the opportunity many have to build a better path to wealth. We want to get over apathy, number 1. Number 2, don't put off to tomorrow what should be done today. Yes, tomorrow will come, but you should be prepared for that. So if you don't have a plan in place today, write me at questions@safefinancial.org, and we're going to begin putting a plan in place for you right now. And the third thing is commit yourself to becoming a master of money. We're going to beat the dead horse all the times we can. Few things are going to affect you more as you get older than the amount of wealth you've accumulated for you to live on. By learning how to manage your wealth, where to put it, how to trade it, when to be in the markets and out of the markets, you're going to come to understand how to make that money grow. And that's the goal, to grow it much faster than inflation. So we want you to become a capitalist. We want you to put away capital. Remember, in the 21st century, money will flow to the owners, not the workers. So you want to be in that position, and you do that with your own capital. Now, we're going to go right now into our super stock segment. We're very pleased. Jeff recorded a message for me this morning, so we're going to go ahead and play that. But I want to thank Jeff Garbaz of Superstock Investor for taking the care and having the concern for you that I do. So, Jeff, go ahead and let's hear what Jeff has to say.
Hello, all listeners of the Master of Money Show. This is Jeff Garbaz, the Superstock Investor. Recently, we've been talking about volatility when we've had discussions with Steve. And boy, has volatility hit so far in 2015. Let's just compare to 2014. In 2014, the S&P fell 3.56% in January and then rose 4.31% in February. Through last Friday, the S&P 500 is up 5.11% in February after having almost as bad a month in January. So this is not a market for the faint of heart, or those who do not have either a buy or a sell discipline. Buying near highs when the trend is down is a guarantee to lose a quick 10 to 25%. Likewise, not having a sell discipline is a guarantee to leave profits on the table. So this week we're going to start a discussion on buy and sell discipline, and this week we're going to hit first on the sell side. So what is the Jeff Garbaz approach to buying and selling stocks? Coca-Cola does not give away the secret formula to produce its famous drink. That said, they do list the ingredients. So we will list a few ingredients on our technical and fundamental measures over the next 2 weeks that we use within our discipline for buying and selling stocks. This week, we're going to address the sell discipline. The first comment on sell discipline is that when you buy a stock, you should know where you want to sell it. That said, there are two concerns when you look at where to sell it. First, where to sell if and when it moves higher. And second, where to sell if and when it moves lower. Always think about these two. Next, I start with fundamentals. First, I use the stock scorecard in Superstock Investor. Never, I repeat, never buy stocks whose price is trading above the price target in the scorecard. It's a recipe for disaster. For me, this is a hard and fast rule. I like to buy low and sell high as it relates to the price targets. Second, I begin to think about selling when the upper limit on the price target is hit or gets close. Next, I like to take the earnings growth rate and divide it by the price-earnings ratio for the current year. I never buy a name with a higher PE than its growth rate. To me, that's simply stock suicide if the growth does not measure up in any one quarter. So I'm not going to buy a name with a PE of 30 that is growing earnings at 20%. That is too rich for my blood. In a nutshell, I do more analysis, but these are a couple fundamental measures that are very helpful to me, especially on the sell side. So for now, those are just a couple ways that we like to look at the sell discipline. Next week, we'll begin a discussion of the buy discipline. Thanks again for having me, Steve.
Well, as always, I want to thank Jeff Garbaz for that commentary. He's a professional in the industry. You've seen him on the program. We hope to have him back. But I appreciate you joining us tonight, and I hope that you take away some very basic information on this, a very fundamental show. We've got to build those plans, and we have to execute them. So join us next week as we continue on that, talking in a little more detail about where we go on these plans. There's an awful lot to it, but we can get it to you in the Master of Money show. Now, we're going to cover this. So, as you know, the Master of Money is produced by the Society to Advance Financial Education. We're a not-for-profit organization dedicated to building a wealthier community, one person at a time. I want to thank our sponsors, Harvest Investment Services and Superstock Investor. And I want to give a special shout out tonight to Ron Blake, who writes the jazz music you hear at the beginning of the show. Ron is a very wonderful performer. He's actually the lead saxophone player for the Saturday Night Live band. And some of you may be aware this week is celebrating the 40th anniversary of that hit comedy show. And Ron is playing all the music for them. So we want to wish Ron and his colleagues at Saturday Night Live well. But thanks, Ron, for doing what you do for the Master of Money. I also want to thank Chris Jans, who's written our theme song that you hear. Chris, again, is a fabulous musician. He also happens to be an investment advisor, but we're real glad, Chris, that you participate as you do in the Master of Money. I want to thank all of you for joining us tonight, and I look forward to seeing you next week for another edition of the Master of Money.